we we're looking at me and Anthony. We spoke a little earlier today, and we're looking at our numbers for the projected closings for this month. And this may be another big month for us this month. So we're excited to kind
Say it, bro. Say it. Say how big.
of we're looking at another 7-figure month in acquisitions and sales this month. We had one in February, and we're looking to have another one this month in June. But as far as this year looks out, we might have a couple this year. So number 2 isn't a big thing, but it's number 2 for us. But it's exciting to hear. But
I know there's a lot of people out there that are making way more money, right? You know, there's some guys out that are doing oil, and we might have a property with oil on it right now. We're still getting some tests done. Yeah, man, I know there's a lot of people doing big numbers, but a lot of the gurus that you guys follow online, they'll brag like, oh, 6-figure month. I had $100,000 month. We're trying to have our second $1 million month this year. So I just say I hate the guru part of it, like the numbers, even talking about the numbers, because I don't like talking about big numbers. It just sounds cheesy, but it is what it is, right? It's the only scoreboard that we have, so that we can share with you guys to say, hey, is what you guys are doing, is it working? Yes or no, right? Because you could be following a fake guru, right? How would you know, right? Everybody's talking shit, everybody's making money selling courses. They're not even doing deals. But what we're doing, it's working. It's working in a terrible effing economy. And it's going amazing, and it's only compounding and getting better, right? We can't tell you that, hey, you know, it's been a little slower this year, and you know, things, they're just not as hot as it was last year. Like, no, we're freaking smoking this year. And this year has been terrible financially for like the whole planet. So just want to let you guys know, like, what we're doing is working. So please don't deviate from what we talk about on these calls.
And we're trying, just so you guys know, we're trying to negotiate. At least Kyle is trying to negotiate a $10 million deal. So
that Kyle guy, he's responsible for about $4 million in contracts in the last couple of months. And yeah, now him and who brought it? Who's he working it with?
Tanisha.
Yeah, Kyle and Tanisha again. $10 million deal. We don't have it, so we're, you know, you want to cap on something that we haven't even accomplished yet. But the buyers get pretty damn close. It sounds like it might go down. $10 million deal, creative finance. You want to talk a little bit about the structure, Daniel? It's like 3 minutes just to kind of give everybody a brief overview, because I know when we're out there making offers on these big ranches and we're getting shot down, we're like, oh man, you know, maybe it's not going to happen. It's not working. This strategy is not working. But I think this deal structure is just sick. I can't believe that somebody would give you a $10 million property with this structure.
Yeah, so we'll do maybe the deal breakdown on this deal once we get
another call, right?
Yeah, another call.
Okay, yeah. Once we get it contracted, or what?
Yeah, I mean, we can show what the structure is, but essentially it's like a 18% down deal with
18% down is what, 1.8 million?
1.8 million. It's a year to close, so we ask for a year timeline to close, and then we ask for no payments for 12 months, and then we have 5 years of seller financing technically, but one of those years is no payments.
So
that's where we're at right now, but
I think we need to rewind that right now. So we're looking at putting 18% down, 1.8 million, right? So everybody on this phone call, you're like, man, Daniel and Anthony just have $2 million laying around? No, that's not how it works. Nobody has $2 million laying around. You borrow it, right? You always leverage when you're going into a new deal. But the magic here is that we have one whole year to close. So we don't have to put 1.8 million down. We're going to be marketing the land for a year. Whatever we don't have sold that's short of that 1.8, that's what we're going to put down. So if we sell 600,000 or $1 million worth of land in a year, then we only need to bring 800,000 on the closing table. That's crazy leverage, right? So that brings us bringing less than 10% down of our own money to the closing table. Super easy. And then no payments for a year on top of that. A year, no payments. So I just want to let you guys know, yeah, does that deal structure right there insane? No interest on this one?
No interest.
Oh my God, this is crazy. Absolutely crazy, guys. I mean, and I guess unless you've been doing this for 6 years, you don't understand the gravity of that. But
it's a debt play, so we're creating.
We're not getting into there yet. Not getting into there yet.
Kyle wants to take them deep. Kyle's trying to take them to deep waters.
No, we're not going to deep waters. We're going to jump into today's call though. So any deal pretty much will be a home run deal if you get 5-year seller financing with 10 to 20% down, and you have some type of timeline to sell lots. Any deal.
And these crazy offers that we're asking you guys to make, it freaking works, guys. And is it frustrating? Yeah. Is it a lot of hours? Yeah. Is it a lot of no's? Yeah. But how in the hell else are you going to come up with a deal where you can make $125,000 a month cash flow?
All right.
You ain't gonna do that in single family. Promise you. Not even in multifamily.
All right. Here we go. We're gonna jump right into it. This is
speaking of deep waters.
Yeah. This is going to be a little high level. If you understand what's going on today, you should have a good
I,
understanding. But
I was gonna say,
I
I think
really
this
want to do
call,
this.
even if it seems like it goes over your head, the more times you hear stuff like this, then the easier it's going to be for you to remember it and talk about it later. So you have to put it on your ears sooner or later to be able to get to stage one. And then when you start to understand it, then this is exactly how we fund the back end of these deals. This is where the magic happens. And I think we're pretty much self-taught in this department, aren't we, Danny? We didn't learn this from anybody, right?
No, we didn't learn this. All
Yeah,
self-taught.
this is just blood, sweat, and tears, guys. So this is super high level game. We all the high level conversations and meetings we've ever been to. I've never heard anybody talk about this. So I'll let you take it away, Daniel. Shut up.
Yeah. So I got my chat open. If you guys have any questions, I'll address it. Anthony's going to come on here and help with any stuff here too. But a lot of the stuff we learned just by doing this stuff. Angie is excited about this call. Like I said, we're if you hear it over and over again, you become better at it, and this makes you a better, well-rounded investor. So this one, if you understand key terms and key phrases, you get really dangerous in the game. All right, we're gonna jump right into it. So this is understanding debt versus equity in real estate, a comprehensive guide. All right, here we go. So a lot of people don't understand what debt and equity means and what's at stake whenever you are having that conversation with somebody. So they do hold different weights depending on where they are in real estate. So this is kind of generalized to all asset classes, but since we're land guys, we're going to cover land and how we use it in land. So we're going to cover real estate notes, debt and equity, characteristics of debt and equity, but how to use investment strategies and debt and equity investment. Kind of cut in a nutshell. What is debt real estate? Debt is real estate refers to borrowed money that is utilized to finance the purchase, development, or improvement of a property and involves obtaining funds from lenders or financial institutions with the agreement to repay. Now, a lot of debt, this is going to be like your hard money lender. He's going to be your mortgager on a flip. It could be a bank, it could be Chase, it could be Wells Fargo. They're going to be your mortgager. So they're going to be debt on whatever asset class. So if it's houses, multifamily storage, land, they're going to be your debt. So they're kind of in a position on the property, not it's actually the owner of the property, but they're secured by the property. It's kind of debt in a nutshell. Now, equity is a little different because this is where us as investors, we play a lot in the equity side. And as you grow as an investor, you should end up on the debt side, which is kind of where some of our lenders come up. A lot of our lenders have a lot of real estate experience, and they've tried to transition from equity investing to debt investing, and that's where we find a lot of private money lenders. So equity side in real estate refers to ownership interests or value that individual or entity holds in a property after accounting. Now, this is direct ownership. This could be a REIT. This could be a fund. This could be a syndication. Whenever somebody raises money for some type of fund structure, they're actually offering shares. Anthony just did a podcast with Corey Thompson, and he was talking about how people that buy into deals, they have equity ownership. It's not debt. Debt is tied to the property through a mortgage or a lien. Ownership, if they buy and as equity partners, they get ownership, they get shares. So a lot of people, they get that mixed up of what is actually debt and equity whenever you're trying to raise money. When you're offering equity as an investment, you're offering shares of ownership. I really want to get that stuck in your head because it took us a while to learn this. Right, Anthony? Equity and debt.
No, it took a little while.
Yeah, it took us a little while. So we're having our own little conversation here. And like I said, a lot of the stuff we learned over time and distance, but it's equity is ownership. All right, here we go. Next slide is the characteristics of debt. Usually debt has fixed payments and they have priority in payment over equity, which is very important. So usually, and this is so funny because we've worked with investors on our deals where we give them priority over payment in equity. Technically, if you have debt is supposed to get paid off first in most cases. So a lot of times, like we're thinking of our first subdividing we did, we purchased $1 million, 107 acres. We paid off that debt because that seller financed 100 acres with $200,000 down. He positioned himself from owner into debt, so we had to pay him off first. for many sales of the property, especially when we subdivide. We can't get a full release of lien on all the property until we pay off that initial debt obligation. So when you convince a seller to go into debt, you have to pay them off first in most cases, unless you negotiate. But it's secured by the collateral of the property in most cases. It's usually fixed payments. I think that first big creative finance deal we did, we negotiated $2,500 a month. So we convinced the seller to go from ownership to debt. So you have to understand what position that goes in and who gets priority whenever you're raising money and pitching sellers to be a certain position on debt equity. So you have to really know what you're talking about when you're asking the position, because a lot of times you're going to talk to their attorney next. You're going to have that conversation with the attorney, and the attorney is going to ask you about if they're debt or equity. And sometimes we might do an equity partnership with that seller. And what does that mean? Equity partnership means they're getting paid last. They're waiting till the deal's done to get paid. Whereas a debt, you have to make some type of payments. And if you do sell some type of property, you have to pay them off in that certain amount. Characteristics of equity. It usually has variable returns, ownership stake, and it's last in line for payment. Anthony, how many deals have we done that we got paid last?
Almost all of them up to this point until we got a little bit more creative.
Almost all of them. So a lot of times like, oh, when am I going to get paid? I'm like, oh, well, you're going to pay. If you're doing what we do, you get paid last.
Sometimes
and
a year later, 6 months later.
6 months later, it is what it is. But it's one of those things where when you take on equity, when you be the equity partner in a deal, sometimes you don't get paid never. Somebody steals the deal. Somebody steals your equity.
Sometimes you got to sue somebody for $350,000 because they didn't send it to you.
Yeah, so it's one of those things where you have the most risk when you are equity, and you take on the most risk because you're not secured. Whether it's your sweat equity, your personal equity, or your cash equity, like all these things it's variable. You can make 100% returns, or you can make 0% return, or you can do negative return and lose your equity at 100%. Use that for ownership stake, and you're last in line. So it's eventually, as you go down this equity and investments in real estate, you should want to become debt, because debt is always secured. Debt always gets paid. That's one thing I want you guys to understand about this. Debt always gets paid. Equity gets more ROI, but debt always gets paid. All right. Real estate notes. There you go. Debt always gets paid. There you go, Jose. All right. A real estate note is a type of debt instrument that represents a legal promise by a borrower to repay a lender a specific amount of money, typically used to finance the purchase of real estate. There's performing and non-performing. So real estate notes, a lot of what gives us an advantage in the marketplace for what we do is we seller finance. Now, a lot of investors, especially a lot of land investors, they buy cash, sell for cash. They buy on terms, and they're always trying to sell whatever way they can. One of our biggest advantages is we create real estate notes. So if you're diving into that space of creating real estate notes, you have to understand what real estate notes, what's their equity, and what do they mean? What do they hold? What's their weight? A lot of like, we learned about real estate notes after we got probably about 2-3 years ago. We learned about real estate notes and the power they have, especially in our space, because we're actually creating that instrument. We're creating that financing. So one of the big advantages that we have in land, especially land flipping, is that there's no access to debt. You can't go to Wells Fargo and get a bank loan. Most people can't. So if we create that debt instrument, which is a real estate note, to service that seller, we have the advantage over the marketplace because we're creating that value with that debt instrument.
Hey guys, think about how powerful that is, right? So you have these big companies, multi-billion, probably trillion-dollar banks, right? Chase, all Wells Fargo, all the guys that everybody like thinks are icons. They won't even give you a loan for land unless you have excellent credit and like 30% down or more, right? So there's nobody servicing this piece of the market. So obviously there's a big crowd of people out there that want land, and they can't afford to pay cash, so they're willing to take a loan on it. Nobody's willing to service those people. So there's a whole like bank missing. Like there should be one master bank that does all that, and there's not one. So think about what we're creating here. That's what we're up against.
And opportunities made where there's no service. Think about the electric vehicle space, or think about like movers and shakers that were first to market. There's no financing in this whole real estate land space as a whole, like nowhere. No one's doing it mainstream at a high level. So if you can offer that as a service, you're already above the rest. You have the upper hand.
So I have a quick question. So you guys, so the way you guys act is, in a way, you're kind of like land banks, or like helping people get into land easier, right?
Yeah,
In a way.
absolutely. Absolutely. That's why we sell a lot of land. That's what gives us the advantage is we provide financing to these owners or to these buyers. We essentially provide bank financing to these buyers through seller financing. Yes, we can acquire through seller financing and have the seller be a bank for us, but we can also,
Mhm.
if you acquire seller financed, or if you have a big enough spread of arbitrage, you can actually offer seller financing to your end user. That's the power.
Okay. Yeah, that sounds really, really good.
Hey, look, so what do you end up with, right? You get $1 million ranch. We think we're going to be able to sell it for like 1.5, 1.8. So we're going to try to make 500 or 800 grand on it. That's probably not all going to be in cash, right? It might be like half in cash and then half on credit. So instead of us making 800,000, we end up with 400 grand in cash and then 400,000 in notes at 12% interest, which is obnoxious. 12% interest. People are crying like losing their houses over 8% interest and 9% interest right now. We're charging 12. So think about that. You don't have to take all the cash. What if we did that same deal? We made zero cash and we only end up with 400,000 in notes. So all we're doing is taking debt equity from this land and then just recycling it back into the marketplace for cash and debt. And that's it.
I think I'm muted. Can you guys hear me?
Yeah, I can hear you.
Okay.
Yes.
I'm trying to find the mute button. I was really muted. Okay. So one of the advantages too is if you do find bank financing, it's even more to your benefit, because if I have $100,000 property and I have a bank that's going to lend on it, I can get 100% of the value. Just like, imagine you think of like houses. People that buy and sell houses every day, they have $100,000 house, they get a FHA loan, they put 3.5% down. The mortgager will bring 97,500 at closing to cover the full purchase price. So if you have the ability to find a loan person that can write the loans, you can essentially get paid in cash, but it's just loan. You have to wait for the loan process to go through, which is another reason why when we're doing land deals, we ask for extended closings. We sold a couple deals where they went and got bank financing because they put a large down, or they had some special bank, whatever. Not everybody has access to that. So we always account for it whenever we're getting due diligence periods on the front end, because if they can find their own lender that they qualify for, we get paid 100%, just like if it was a cash buyer. So I'm all for it. But if they don't have that ability, I'm gonna provide my own financing to them through a real estate note. All right, moving on. All right, advantages of debt in real estate: it's predictable income, it's lower risk, and it's secured by the property. This is what we tell sellers. We tell sellers about this advantages of real estate debt. So the reason why we're talking about this as a whole is because you might position a seller to be the debt. You might need some type of debt instrument to get a buyer on the thing. So all this, like, oh, this is over my head. You need to learn this stuff eventually because it helps you do more business in the real estate business as a whole. If you can get more sellers to become debt, hey, you can get predictable income. It's lower risk. You're secured by your property. Like a lot of times we have that thing that comes up like, oh, how did I know you're going to pay me back? Well, one, I'm going to put a large down payment. Two, it's secured by your property. You think your property is not worth that much? Well, yeah, it's worth that much. Okay, then it's secured by your property. You're always secure. You as a seller, you get a large down payment, and you're secured by the property. What's the risk? You know. So it's having that conversation with the seller and tell them the tax advantages of this. What books do you recommend that goes into this further? Invest in Debt by Jimmy Napier is a great book. 100%, Victor. I recommend that book all the time. But yeah, this is one of those things where you convince the seller to become a debt instrument on their own property. All right.
Can I do a real world example, Daniel, to make this relevant?
Absolutely. Hop in.
Okay, so think about this, guys. Let's say you go to Chase Bank, right? You go to Wells Fargo, you go to one of the big boys, and you say, "Hey, I need to borrow $100,000." Right? They're like, "Okay, hell no, ain't gonna happen," right? Unless you have excellent credit, crazy financials. They want to just they want to know what you eat for breakfast, right? So you're probably not going to get that loan for starters. So if you don't have cash on hand, right, and you're trying to borrow some, you're not going to get it from a traditional institution. It's just not going to happen, right? But you find this listing that's listed on the south side of San Antonio for 6 months that nobody's hit up. You go in there, you set up a deal with sellers where you're going to give them a down payment and they're going to release a certain amount of the land to you, and you take out $1.3 million out of the property in 60 days, right? So when you're out there getting these loans, how does that benefit you? And like, who cares? I got some debt on the property. Lady financed it to me, great. But now you just gave yourself a $2 million loan or a $10 million loan that you can share the equity with, right? You can actually pull some of that live equity out of that property now. So that's what we're doing here. You're going out and you're giving yourself multi-million-dollar loans and then taking some cash out of that loan. So let's say one of your rich homies goes and takes out a $10 million loan from the bank. You help facilitate it, and they're like, "Here, let me kick you down $1 million for taking that 10 out for me." So that's what we're doing. We're asking you guys to go out there, get millions and millions of dollars worth of debt so we can take the cash out of that debt.
Another way to put it too is think about the Burr method. You buy, you rehab, you refinance, repeat. Imagine essentially we're doing a refinance on land that has equity at 0%. We're doing a refinance on equity at 0% on equity we create through subdivision. If you need to listen to this again, you need to listen to it again. That's the power. It's huge. All right. Disadvantages to debt and real estate. Limited upside potential, foreclosure risk, and fixed return. So a lot of times you have a limited upside, but it's less risk. I think the next slide is coming. Do you want a guaranteed return? Okay, I won't say guaranteed. I won't say guaranteed. Do you want a steady return, or do you want a higher return with more risk? When you are as a debt, you have foreclosure risk. When you have debt and you borrow, if you have debt against your property, you have foreclosure risk. If you don't make the payments, we saw this 2008. They got underwater, foreclosure, boom, 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 thousands of foreclosures everywhere. Fixed return, and a lot of times you cannot change your ROI if you are the debt. Like the bank can't change the return. The only way debt they get a higher return or lower rate of return is if they're always secured by the property, but if they pay back sooner. I did a whole thread on this on Twitter. There's a whole Dave Ramsey people were like, "Hey, if I pay extra payments towards my loan, I'll knock out my loan in 10 years versus 30, right? You hear that all the time, right? What you don't understand, and it depends on who you are, not knocking it, whoever teaches that or whatever it is. But whenever you pay back that loan quicker, you're actually accelerating the ROI to the debt, and you're actually paying a higher effective interest rate. So on Twitter, I did the math of a 10% interest loan. Essentially, if somebody paid off that loan in 15 years by making extra payments, they effectively paid a 15% ROI to the loan because they paid it back sooner. So when you get a 30-year loan at 5%, that 5% loan is across 30 years. So if you shorten that loan and pay it back, whether you move, you refinance, you sell, the bank gets a higher yield, which is ROI, on their money invested, which is why banks like when you sell, they like when you refinance, they like when you do all those things because it just recycles their money and they get a higher yield on that debt. So you can only increase the ROI when somebody pays back sooner. All right, okay. Disadvantages of equity in real estate, or the advantages. Sorry, advantages of equity in real estate. You can get really great returns. I think me and Anthony have done really great returns. We get to property appreciation of whatever subdivision value add we increase, and then if you're doing some type of fund, you get dividends. So I kind of generalize this for a lot of different type of real estate transactions, but you do get a lot of advantages to equity for being an equity position on real estate. All right, what's the next slide? Disadvantages of equity in real estate. All right, so this is the disadvantages. We kind of talked a little bit earlier, but it's higher risk. You might have market volatility. I had so many gurus that were in houses. They all had a bad year last year. All of them. So your equity is whatever equity you might think you have is subject to the market.
We saw a bunch of the equity go away. We saw people lose houses. I have an amigo that lost 2 apartment complexes. So I don't know, I don't know which asset class is the best, but we haven't had any losses, anything like that at all. So this is a pretty safe game that we're playing.
You're last in line for payment. Like you're not going to get paid if you got a bunch of liens on your property, whether that's a mortgage, HOA lien, you got private money, hard money lender, private money lender. Like you're last in line. If your equity disappears, you're out. There goes your potential ROI on all your effort that you did. So this is what I was talking about. Now, higher risk return, high potential, low risk return, it's low risk. So you have to figure out where you are in life based off of how much money you want to invest. And this is something you maybe pitched. Like once you understand this part of it, you can pitch sellers, you can pitch private money, you could pitch you in your own investing career. You can choose what you want to do. So a lot of times people that have more money, they're willing to do they want low risk, low returns because they just want to beat inflation. When you're broke and you're trying to turn a nickel into a dollar, you got to do high risk, high return things. This is how me and Anthony got out of the gutter. Like we're doing high risk, higher potential returns of doing. We're putting our equity on the line to make more money as a whole, as an investment company on our side. But we might tell a seller like, hey, instead of holding on to this for whatever, I can give you a low risk, low rate return on your property. So you can kind of formulate this whatever you are in your position. Some of our lenders, they have a higher net worth and they want to double it up. So they're willing to put high risk for higher return on riskier stuff. So it depends on where you're at in life and your risk tolerance and of course your current capital position. But if you're broke, you gotta turn a nickel into a dollar as fast as you can. And this is one of the things where you got to understand your position. And this is why I think wholesaling is great. This is why I think wholesale, like any type of basic real estate investment, I love wholesaling. Me and Anthony are a product of wholesaling because we understand we had to turn a nickel into a dollar as quick as possible. It's different.
So for someone who doesn't have a lot of starting capital and they want to turn a nickel into a dollar, like, because I know large acre usually, you're looking for the long run. You're looking because I heard like you guys were talking about how the closings usually last like 6 months to a year.
Mm-hmm.
So then, how would what would be like another advantage of going through land or large acres if you're looking to like maybe close within 2 months or maybe a month, right? If there's something like that.
It depends on where you're at. Like all this stuff is very subjective. We like big land because it's faster than apartments. We like big land because it's more value than houses. So you kind of take on different valuation risk and exit potential. So like think about this. You can contract the house and wholesale a house in a week. You can do it under 30 days. You can do a small land deal in under 30 days. I've seen people do infill lots and they contracted it one day and sold it the next day. So you can do smaller stuff to accelerate that capital. But when you start doing bigger stuff, you got a longer time horizon. We're buying 60 acres next week. That deal took 90 days to close. It just took 90 days to close. We had to wait for surveys. We had to wait for title commitment. We had to wait for like finalizing surveys at the end because we're doing a subdivide on it. Like there's just a lot of time that happens in land deals when you're doing bigger stuff. So
I was going to say, Daniel,
go ahead.
We have the 10 commandments for this group though that addresses that right away. So that's kind of one of the rules for our group. It's just don't only do big land deals. Like, of course, that's the biggest, best money that you're going to make. But if you're only well hunting like anything else, and you're only getting paid twice a year, it's going to be a long year. So we encourage you, go out and get little stuff. And then I was going to add one more thing. If you do have smaller amounts of capital to invest, like $1,000, $2,000, $5,000, you can do like gator lending with us. So that's something that's very simple to place small amounts of capital into deals. So we have a lot of deal flow, but there's a lot of different ways to cut this thing up. But I would recommend that everybody stay focused on what you're going to focus on. If you're going to do apartments, do apartments. If you're going to do storage, do storage. But if you're trying to do land and houses and storage and all this other crap, you're always going to be chasing your tail because you're not going to get momentum. So the recommendation that we have for this group, it's a commandment, it's not a recommendation, is do big deals and small deals.
Yeah.
All the time.
The small deals have a shorter time horizon to make money. The big deals have a larger capital outlay, but they have a longer time horizon. So our whole thing is we switched to doing larger deals about a year and a half ago, and we didn't close very many deals for like 6 months just because we had that long time horizon. Now that we're in a year and a half, closing. We're having a lot of closings line up and we're stacking them all up in a month. We're having $1 million months. Like there's a lot of things happening right now just because we built up that momentum months ago. So I think 100% you need to start small depending on where you're at, but keep an eye out for bigger stuff. This is why we teach about bigger stuff, because we're looking for bigger stuff. So if you see something, a lot of times you can't see what's out there if you don't even know it exists. So we're trying to educate.
Hey, Kyle's right.
Like what the big stuff looks like, and then you kind of keep your eyes open.
Kyle's a perfect example. Like he sent us a bunch of deals that we shot down because he didn't know what a deal looked like, and now he's bringing some of the best deals we've ever seen before.
Yep,
and he did it quick, just a few months.
Yep, absolutely.
Yeah, knowing how to identify a deal in this business is everything, and then once you get better at it, it's a superpower. I mean, it's magic. I was with my friend at lunch, and we were just talking. We're at a barbecue place. And he's like, yeah, I know where there's a little tract over here. It's a couple acres. And he told me the area, the price. And I'm like, man, that doesn't sound like a deal. Let me check it out. So at the table, I opened up Landglide, and it was cut into 2 pieces. I drove straight from the restaurant by the Dominion by Bernie all the way down there towards Pleasanton, like an hour and 10-minute drive. As soon as I saw what it was, I didn't even have that on my radar. But that's what it feels like. You can identify a deal. Then you can go from, nope, that price isn't going to work. And then you take a look at the property. I'm like, okay, this is a deal. I'm on the way right now.
Yeah,
change plans.
We're coming out with more education here in a little bit to train you guys better on what to look for. Like I said, the whole point of this call is to kind of understand just like a lot of key terms and where you position sellers, where you talk to lenders, and you have to understand these things. So most of the time to get a seller to take on a debt position or to get a lender to lend on your deal, like you have to understand this stuff. Next, combining debt and equity. So I think this is a huge advantage. It's a combination of debt and equity used by a company to finance overall operations and growth, balanced portfolio, use of leverage, and examples of mixed investments. Thee and Anthony are big components of combining debt and equity. What do I mean by that? So what's the term you use? I forget. I can't remember. What was the term you used, Anthony? I felt like
blended capital?
No, it's blended capital. That is right. Yeah. Anthony calls it blended capital. Now, what is blended capital? So blended capital, and somebody asked what gator lending is a little while ago, but blended capital is using every type of capital. So let's do an example. So let's say we're buying 100 acres for $10,000 an acre, and it's $100,000 down. Well, you need EMD, usually 1%. You're gonna need 10 grand. Who's gonna put up 10 grand? Well, if it's you, that's your capital. If you use a lender, that's private capital. If you put it into your purchase price, that's seller financing. So you can use different types of capital for different things. Wholesalers use blended capital when they're wholesaling. They contract the property for $1,000 EMD, and then they'll make the wholesale buyer put $5,000. They're using wholesale blended capital in that transaction. So it's blended capital. So you can use different types of capital. So if you have hard money, private money, seller financing, gator lending. Gator lending, for somebody asked a second ago, is like lending on like EMD. It's usually $2,000 to $20,000. Maybe it's putting up surveys. Maybe it's putting up a water study cost. Like it's something that we need $5,000 for, and we can give somebody an ROI to it, and we don't have to use our own money. Like you can use blended capital. So you have your seller financing. Kyle's deal that he's negotiating, seller financing is a form of debt and equity. Now, when you value the property, you have your own equity you're putting into the property. So you have private capital, like hard money, gator lending, seller financing. We use as many capital resources on every deal that we can. And one of the big components of blended capital is every deal we're trying to buy hopefully has some type of seller financing on it, especially the bigger properties, because we want to leverage that seller financing because we cannot get bank capital or hard money capital. It's a lot harder because they're fighting over first, second position. So you have to understand the capital stack. We're going to cover capital stacks. I think it's the next slide coming up. But you have to understand what type of capital position you can provide based off of where you're raising the money on the capital stack. We'll cover that in a second. But blended capital is important. I think it's the slide after this. All right, real estate notes, and a note would be some type of capital as well, a blended capital. Real estate notes investing can be profitable and valuable in addition to your investment portfolio. By investing in real estate mortgage notes, you essentially become the lender and receive payments from the borrower over the life of the loan. And it's a role of diversification, balance risk, and return with notes. So one of the biggest reasons why we're doing this type of call is because we're trying to educate people on investing in notes. If we get one of the bigger reasons we're raising a lot of capital, we're raising capital for Gator lending. We're raising capital for private lending, who's going to be maybe help us put we raised $200,000 for our first seven-figure deal. That was private capital. We raised money for that. We asked for seller financing. We got seller financing a lot on deals where that's asking for it. And then whenever we create those notes, we talked about creating notes a little bit earlier. Sometimes we'll sell those notes to end buyers. When you create a note and you sell it, you have a very big cash burn problem. So let's say hypothetically you create $100,000 note at 10% and for 10 years, right? If I create that debt, when you do that with a bank, FHA comes and buys that loan and they repay back that lender. When we do it, we have to find a note buyer to buy that note, and now they put $100,000 into this debt instrument, and now they receive payments from that buyer. So we're always looking for different types of blended capital based off of different things. So like a lot of our private capital, they want big portions of equity. This is all coming together throughout this whole call. So if you need to listen to this again, we'll release it live and you can listen to it again. But we're looking for all different types of capital. So we have private capital investors, not that they're sharks, but they want a big portion of our equity. And we give them a big portion of equity, give them a big portion of our upside, but it's a lot more risk, right? Whereas there's my people that don't want to take on that risk. They want to save for investment. I had a conversation with one of our lenders. He might be interested in notes because it's secured by the asset. It's very passive compared to actively investing on a private, and there's a lot more risk. He gets a flat rate of return, monthly cash flow, and it just kind of comes in. So there's different appetites based off of your risk tolerance and your current capital position, and everybody's different, completely different. You might know an aunt that has $1 million just sitting in the bank account. She would love an investment like a note. You might have your cousin that has $100,000, and he's like, I want to retire in 5 years. I need to flip this $100,000 as many times as possible. Boom, we'll put him in a private money lending situation. So you have different positions for people in different phases of their life, and notes is just one of those things. So it's a way to kind of spread out your capital risk in your portfolio. Anything for this, Anthony?
Yeah, I don't know what you're going to cover on the presentation, but I wanted to talk about how it's pertinent, right? Because you have lenders that don't want to be into a deal for 2 years or 3 years. And then so how we use this strategy to work with different lenders for different timeframes.
Yep. You want me to cover that? Or are you going to cover that?
I don't know if that was part of your presentation. I could just briefly mention it and talk about it.
Go ahead and mention it.
Okay, yep. So Daniel was talking about the different types of lenders that we have. So just take a prime deal, right? Like the one that we have, the 243 acres down there in south of San Antonio. So we've got 1.6 in debt from the property owner themselves at 0% interest. Then we borrowed $1 million in private money, right? And now that private money, he wants to be out in 12 months. And so we told him that give us 18 max and we'll get him out, right? So we have somewhere between 12 and 18. He's fine with 18 months. That's what he signed up for, by the way. But at that point, we'll have a lot of lots sold, right? To pay off most of what we owe him. But at that point, we can look at bringing in hard money, right, to pay the property off, and possibly even the property owner. We could bring in somebody else, some other private money from somebody else to get everybody out of the deal and bring in a fresh lender. Yeah, we can bring in a bank. So there's a million different ways that you can use these different types of capital. And and I think most of us think, hey, I'm just going to borrow private. I'm just going to go to a bank. I'm going to go to a lender, right? Or I'm going to get seller finance. But what we've been doing is we've been combining all of these, and it's been easier to raise capital, again, because of the ask, right? The size of the ask. Hey, I need to borrow $1 million, 3 years. And most private lenders are going to say, hell no, I could just flip it faster myself. I'm good. So what we're doing now is we're able to swap lenders out to navigate a deal like this. So Kyle has one south of San Antonio. We're probably going to need about $1 million for engineering costs, right? Soft costs. So we, from lender one, we're about 250 to 350. They'll handle the engineering, right? So let's say after all the approvals are done, 12 months from now we have a subdivision. We don't have raw land anymore. We have an entitled subdivision that's ready to go, ready to break ground. So we can bring in a fresh lender at that time from a different capital source to keep the deal moving. Lender one gets out, he's happy, he got his profit. Lender two comes in, he's fresh, he's ready to go. So we don't have to have one lender waiting for years and years to get paid on a deal, which I think is tremendous.
So think about this. Now, we recently learned about this recently, but think about all these people that they're investing in storage. They buy unstabilized storage or multifamily, and then they stabilize it, they hold it for 3 to 5 years, and they exit. Imagine if you raised another entity that was just a holding company. Like, they want passive, low rate, low risk, low returns. Like, when you value add a property, it's a lot of risk. Entitlement, flipping, subdividing, all that stuff. You add units, you remodel units on a multifamily or storage. Like, that's a lot of risk. But if you have a lender that would, not a lender, if you had another entity that you created yourself to buy your entity, you can wash your hands with your left and right hand to the next entity. So you have Capital One actually entitles the property. Capital Two might be the one that actually builds the property. So this is what we're trying to do with Poteet. So we have entitlement capital that's entitling the land, and then most people just sell it to a builder. We're actually trying to raise money to entity two, that's us again, that's actually going to build the property versus selling it to another person. So we can make money from our own deal in multiple stages by bringing in this blended capital. This is high level for you. I understand I'm in the weeds a little bit. Listen to it again. Listen over and over again. This call alone will cover a lot of your real estate investor thesis. And once you understand it, you get a better picture to pitch investors, pitch sellers, pitch buyers. Like I had a guy on the podcast, one of his buyers out of his property ended up becoming one of his best lenders. Like, this stuff happens and people switch positions. Not everybody fits in one box and that's all they do. They eventually move and migrate into different equity positions, and they might turn into different other forms of capital. All right. Next slide. All right. Debt investing, you have real estate notes, ROI, and you get a fixed interest periodically. Equity, you get dividends, it's funds, you get a lot of different stuff. I think we covered a lot of this slide, is you have different types of setups for different types of positions, and you can have sellers or buyers or even lenders move to different positions based off of when the way you're moving the deal. So I think the next slide is what I'll get to. Okay, this is the slide I wanted to get to. Okay, so this is the capital stack. We talked about the capital stack a couple weeks ago. This is so important when you understand your position based off of your when you're raising with sellers. This is kind of the perfect graphic on the right here. So let me go through the points here, and then we'll kind of cover the graphic. So the position in the capital stack, seller financing typically sits behind senior debt, but before equity in the repayment hierarchy. So this is kind of like for multifamily syndications, we might not have senior debt or mezzanine debt, preferred equity. Like, those are like high level terms. We'll cover that in a second. Characteristics of debt acts as secured loan with the fixed repayment terms and interest, providing income streams for the seller. And for buyers, it's easier to access to financing and reduce upfront equity requirement. And for sellers, it attracts more buyers and generates interest income. The risk comparison, seller financing lower risk than equity, but higher risk than senior debt due to subordinate position. So the debt position is very, very important when you're talking about seller financing, when you're talking about hard money loans, when you're talking about partial seller financing, when you're raising money for a partial equity position. on a deal, you have different positions. And equity is higher potential returns but stands last line for repayment. So let's talk about what that left means, and we'll talk about the right. Just pay attention to the right. So senior debt is, let's say you have a multifamily deal. Multifamily deals, I was talking to a guy, I think yesterday or 2 days ago. He said he usually buys 65-35. So you have 100% of a property, let's say it's $1 million. The bank will fund 65% of it. He has to come up with 35%. So if it's $1 million, he has to come up with 350. The bank will come up with 650, and that's how you kind of get your purchase of that property. So think of this little stack on the right as your different positions. So senior debt could be your first position loan. It could be seller financing. It could be the person that's putting on the biggest tranche on your raise. They have higher hierarchy in that position. Preferred equity might be your private money lender that gives you 200 grand to entitle a deal. He might be the person that puts up EMD. He might be the person that puts up a lot of that due diligence cost. So usually for us, we give a lot higher equity position, even for small amounts, just because we know the risk it's in the transaction. So you have to understand where you're positioning sellers. Like one thing we always try and do is we always try and make sure sellers are. We sometimes pitch second position, but we usually get flack because they're in second position. So we found if you don't get anything off of this call, we'll give you a little sauce here on this. But if you have a deed, let's say the deed's on the left, and you have your mortgage, the mortgage and the deed are connected through a deed of trust. So if you ask a seller to become who's owner to become a mortgager, how do you offer position? So if you need to raise a lot of money, usually what happens is the money, let's say you raise 50% of a deal and they want first position. You can't ask the seller to be second, but most of the time they're going to give you pushback because now they're in a lower position than the equity, and they have potential to lose that equity position on the debt side, right? Because they're in a lower position. So one thing we've learned is you can actually keep them on as an owner, just not a ownership position. That way they're still in common equity side on the deed, and you still can get a first position loan on the debt side, if that makes sense. I know I'm into the weeds. I apologize. But I'm telling you, there's some people here that are eating this up. Anthony, anything for that? I know I'm in the weeds. You have to listen to that again. Sorry. Okay. So if you understand real estate, you have the deed, which has ownership of the property, and then you have your mortgage or your debt, right? You have different positions on your debt. You might have your bank loan, Chase Bank, and then you have a HELOC, which is Chase Bank again, and then you might have might be liens. So you might have a HOA lien, you might have a child support lien. Like anybody that's dealing with like dirty title problems, they got all these liens that stack up under this equity stack on the debt side, right? So if you ask a seller for seller financing and you're bringing a significant amount to cover the deed, you can leave them on as an owner. That way they still have ownership, but you can put them in second position. So they still have ownership equity stake, but there's a lower tier debt on the debt side. Yeah, I know. Crickets.
Can you repeat the benefit of that, please?
The benefit of that is when you're getting seller financing, you can put them in a lower tier debt position, but they still have hierarchy on your ownership position. So you can hit two birds with one stone. Because no one wants to be second position debt behind a bank or a hard money lender. No one does. But if you give them ownership stake, essentially shares, remember we talked about ownership shares, you can give them ownership shares to secure their second position debt. That's how you can get first position debt, hard money, bank financing, and still have them seller finance in second position.
I'm still confused, but thank you.
Yes, the lower position liens have more risk, Jose. So I know it's a lot. I apologize. I knew I was going to the weeds on that one. But it's once you understand this, it gives you perspective. And you can negotiate better when you have perspective when you're actually doing acquisitions. So, Kyle, do you have any 2 cents on this? Because Kyle's learned a lot about this in the last 120 days. And it helps you become a better negotiator.
Now you just got to keep an open mind and be a sponge. That's really it. Rewatch this recording a couple times and just start to think about it. And then you'll come across scenarios, and then that's really how you learn is just do the action. But just keep an open mind and keep it in mind when you're negotiating. And as you keep hearing it and as you listen to this recording over and over again, you'll look at something and be like, this is when I can use it.
Yeah. All right.
Yeah, that's what I was going to say. No, I was going to say, no matter how high level this is, even if you only grab 2% of it or 5% of it, that's a lot. And then, a lot of people have asked us since we started this whole company, why don't you guys have a script? Why don't you guys have this? Why don't you guys have that? Because my philosophy has always been, I don't want anybody sitting down reading a script. I want you making phone calls because that's how you learn this stuff by putting it to use. And that's what Kyle just said again. He said that, when you see the opportunity pop up, when you're negotiating, when you're in the middle of a conversation, that's when that muscle memory is going to come in and you're going to remember, oh, this is what Daniel was talking about on the call. Right. Or at least you'll have a way to make multiple offers. We refer to it as pushing all the buttons on the elevator. Right. You get in with a kid and he pushes all 40 buttons. That's what we do to the sellers. Right. We talk to them and we mention a lot of different things and see what they bite on. Right. So you don't need to learn all this tonight, but just at least being introduced to the vocabulary and the ideas, it's going to help you in the long run big time.
Is your capital stack laid out in each contract? A lot of times we don't lay out the capital stack, but we try. We've had conversations with their attorneys just to have them understand where they lay out in the capital stack. And that's a conversation we have with attorneys. Like, you have to learn this stuff when you do this at a high level, because if an attorney asks you a high level question and you don't have the answer, like, the better you can answer that question, the more credibility you have. So this is why me and Anthony are really good at this type of stuff, because we can answer these questions. Like, you got to deal with the objections you're going to get when you're asking for seller financing on a $10 million deal. You got to deal with that. And if you don't know how to answer that, you're never going to get it. So a lot of this stuff, it's technically defined. It's in the purchase and sale agreement, but it's not necessarily signed in like a capital stack format. If we're asking for seller financing, hey, you're going to be in first position. Usually, in most cases, we're trying to give them first position, but in some cases, we've had negotiated them to be second and give them ownership shares. And essentially, it's a JV, and it's secure. Their ownership equity is secured by their own position in second position, because we've had to. A lot of times, sellers don't have $500,000 or $1 million to value add their property to a $5 million valuation. So that's where you kind of have that conversation. Hey, I can raise the money, $500,000 or $1 million needed to make this property worth $5 million. Are you okay being in a lower position and be on this ride with me to make this into a $5 million property? And a lot of times we're having conversations with sellers is, hey, if we're doing stuff with seller financing, me and Anthony are like, hey, me and you need to vibe, because we're going to be in this transaction for a long time, and me and you need to get along. This isn't a buyer-seller relationship. This is almost like a partnership, because now I'm bringing in my capital, my resources to value add your property. And if you really want that high number, you're going to have to work with me. And that's where we get seller financing, is where we're bringing in our negotiation expertise and our capital that we raise to value add the property, and we're willing to pay their price. Hey, Kyle, want to throw in a curveball? How much was that listing for? Don't do the exact number because it's still out there, but how much did we raise the price?
Like 550 or 600 or something like that.
Okay, so there was a $9 million deal listed on the MLS. We offered $10 million. So we actually raised the price of the purchase price just in turn to get our terms. So the bigger the value, we can actually increase the price of what we're willing to pay for it. So a lot of times these sellers are like, oh, I want $30,000 an acre. 30,000 acres pretty crazy for cash. Like it's just crazy. But I can give you that 30,000 if you let me value at it. Okay, what does that look like? Well, it's going to take A, B, and C. It's going to take me an entitlement. It's going to take me to subdivide it. It's going to take me 6 months. It's going to take me 12 months, and I'll get you your 30,000 an acre. But it's not worth 30,000 acre cash. Okay, well, what do you exactly bring to the table? Well, A, I'm going to raise my own money or put in my own money. I'm going to value add your property to 50,000 an acre, and I'll give you 30. Oh, that makes sense. How much time you need? It's a totally different conversation. So a lot of times on the bigger properties, we're not even negotiating on price. We always, and most of our properties, we're making full price offers. This is why we're picking up properties off the MLS. Kyle, let me think about this. The 3 properties you contracted are full price, right?
Every single one, yeah.
They're full price offers on the MLS.
Think about that, guys.
Actually,
99 investors out of 100 out there are out there making lowball, insulting offers, and then you come in and you offer 600,000 over asking.
Yeah.
I mean, on the one I locked up, the agent didn't even think the seller would be open to terms, and then he said he talked to the seller, and the seller was open to terms. So a lot of times the agents don't even know either that the sellers will be into it.
So this is the value. If you're still here right now, that's the value. Kyle's $4 million he locked up were all full price offers. All full price offers. It was just asking for the term and timelines that we need to value add the property. That's it. I don't care what the seller wants, as long as they give me the timeline to value add it. That's where I make my money. That's where I make my money.
Hey, I think that's about a wrap right there. And I think Kyle wanted to have a quick announcement too.
Boom.
Good job, Daniel. Thank you, man. I think we should have this. We should have this conversation a lot more often too, guys. I know there was a lot, and if you were on this call, we will send you the recording. But you just got to hear it over and over again, and then ultimately, guys, you got to play the game. So if you're just on these calls, just listening, and not taking any action, that's gonna be hurtful, because you can be like stuck in analysis paralysis forever, years. Grab somebody else on this team. There's the people in this room are willing to help you. There's a lot of people in this room that are having success, and they're willing to help you. I don't know where else. There's not that many other places where people are willing to just give you their secrets and their time to help you make you money. And this environment is perfect for that. That's what we cultivated it for. So take advantage and make friends and talk to other people in the group. We're here to help you.
So one thing I want to say too is that we're having our event July 31st. We're actually going to dedicate some time to kind of cover our organization and set up an acquisition. So you can actually ask our acquisition. You can ask our construction coordinator. You can ask our underwriting questions live on our panel. So we're going to dedicate a good 30 minutes to an hour to a panel to ask our live team about anything. And these are, like I said, we're projected to do our 7-figure month in June, second for the year, and I think we have many more lined up for the rest of the year. So I hope you all can make it. We'll hopefully see you there. It is the hiveislive.com/event, and that's where you go to get the URL. This will be put as a podcast episode, so this episode will be out there. And if you need to watch it again, it's okay. Like I said, it took me a long time to learn all this, which is really I wanted to get it to you guys like in this format, and I wanted to release it on YouTube and put it out as a podcast and all that stuff, because I know it's valuable information. This is the information that we use currently every day to do big deals, and a lot of this educational stuff that a lot of people aren't willing to learn. This is what separates you from doing bigger transactions as a whole, is knowing this type of framework, terminology, negotiations. You can negotiate big deals.
So I have 2 questions, just regarding like what do you mean by value add when you were talking about like the seller? How does that work, or what is that? What does that mean?
So value add is as throwing in money into a property to increase the valuation. So storage people might add more units. Apartment people might remodel units, fix up the roofing, fix the AC, put a driveway in, fix the paint in the parking spaces, put a new signage out. That's how they increase value to increase their rents. We do it by adding paperwork. So we subdivide, we entitle. That's how we value add land. So it's different things.
It kind of reminds me of like a novation in a way. Do you remember what that was?
Yeah.
Novation?
We're doing a form of innovation by leveraging seller financing.
Yeah. Okay, that makes sense. Yeah. Okay. And then the second question was regarding what was the second question again? Wait. Okay. Oh yeah, it was regarding this recording. So like, are you guys gonna need like our emails if you're gonna send the recording to us? Or...
We'll post it in the group.
Oh, okay. Okay. Gotcha. Okay.
Hey guys, we hope you're enjoying this content. If you have leads that you need to dispo anywhere in the country, please visit hivebc.io, like hivebuyersclub.io, and we'll help you move those deals that you need to get into the marketplace.